Every month, you transfer a fraction of your paycheck into a savings account. $100 here, $200 there. You hit your targets. It feels responsible, disciplined. Then, at the end of the year, you open your app and look at the bottom line. You held $10,000 in that account for 12 months, and it earned exactly $50. But the math is actually worse. While that balance barely moved, the cost of living climbed. By the time you factor in the invisible drain of inflation, the real purchasing power of that money has actually dropped. Relying on a savings account for long-term security means your capital is effectively losing a race against the cost of living. It is a structure built for storage, not for growth. The cultural conversation around money focuses almost entirely on the habits of reckless spenders versus the habits of disciplined savers. This overlooks the mechanical divide between saving and investing. Saving is a defensive maneuver. It is designed to preserve what you already have and keep it accessible. Investing is the offensive engine required to generate wealth. It moves capital into the economy to capture growth and compound over time. A stable future depends on these two systems running in parallel. Yet most people stay exclusively on the defensive, waiting for a security that savings alone cannot provide. This chart shows the mechanical difference between those two strategies. The bottom line tracks a standard savings account earning 1% a year. The top line traces the historical 10% average annual return of broad stock market indices over extended periods. The driver separating these two outcomes is time. As years turn into decades, the returns on the upper line begin generating their own returns. The money multiplies, creating an enormous divide in actual accumulated wealth. Owning a diverse slice of the stock market captures this compounding effect automatically. You buy in, you hold, and the collective growth of the economy does the heavy lifting. The numbers are clear. The math is completely definitive, which means there has to be a very strong reason why so many people look at this exact math and refuse to participate. The true barrier is human psychology. We are wired to react violently to the immediate threat of loss. A savings account offers perfect emotional comfort because it never drops 5% on a random Tuesday. The stock market, by design, experiences constant, chaotic daily swings in value. Throughout history, the market has routinely experienced sharp corrections and severe crashes. In these moments, the environment becomes a frenzy of selling as institutional and individual participants scramble to protect their assets. That institutional panic inevitably bleeds out into the streets. It dominates the news cycle and creates a visceral, lingering fear for everyday people who watch their retirement accounts temporarily shrink. This cycle of volatility traps millions in financial slow motion. Breaking out requires a plan that accounts for human panic as much as it accounts for mathematical returns. The first step is building a financial shield. Before buying a single stock, you accumulate an emergency fund covering 3 to 6 months of living expenses, held strictly in cash. This cash buffer acts as a shock absorber. It sits waiting to absorb the impact of sudden job losses, expensive medical bills, or major repairs, so your investments never have to. With the shield built, mentally divide your finances into 2 categories: safety money and growth money. Safety money protects your current lifestyle. Growth money is what you invest. It is securely isolated to build your future decades from now. The presence of a cash shield means a market crash is no longer an immediate threat to your housing or food security. The panic of a falling portfolio is contained because your survival money is stored securely elsewhere. With the fear neutralized, you can begin investing. And contrary to popular belief, you do not need thousands of dollars to start, nor do you need to strike it rich overnight. The third step is simply building the habit with small amounts. Making steady, consistent deposits month after month reliably outpaces throwing large random sums into the market whenever you happen to remember. Step 4 is keeping the strategy simple. You skip the complex day trading, the options contracts, and the highly speculative bets. This diagram represents a broad market index fund. By purchasing one single asset, you instantly distribute your money across hundreds of major companies, capturing the collective growth of the entire group. Massive wealth is almost never the result of a single lucky guess. It is the result of thousands of simple, disciplined decisions, automated and repeated over many years. When you view the market through this lens, sudden crashes lose their terror. They are natural, historical cycles. For the long-term investor, a market decline simply means that valuable assets are temporarily on sale. The goal is learning how to pair these two forces. You save to guarantee your stability today, and you invest to secure your freedom tomorrow. When the returns on your investments begin to exceed your own monthly contributions, the math of your future moves into a different stage. The wealth you've built begins to sustain itself.